My name is Paul Ellis. On behalf of the New York Technology Council, we're pleased to welcome you here to this presentation, Long-Range Planning for the Successful Sale of a Company. So the goals of today's session. We're talking about long-range planning, not the run-up to the event. So for those of you who are familiar with the M&A process, there's a lot that happens in the last few weeks and months, but we're really talking about what happens in the last 1 to 2 years, okay? We're focused on the factors that are going to build value, make the company attractive, make the process as smooth as possible. And that's something we'll come back to a number of times. Things which you can do in advance, which are going to smooth things along the way, will be of benefit to you as the owner, because time is not your friend when it comes to selling your company. The longer the process takes, the more likely things will go wrong or go sideways, and that will affect the purchase price, which generally speaking only goes in one direction, which is down once the term sheet has been signed. What we're talking about are things that are equally applicable to early stage or established companies. And then lastly, I'd say we're not here to really give you answers, but to help you to know what the questions are. We lawyers call this issue spotting. We want you to know, when a certain set of circumstances or events comes along, that's something they talked about in that event. This is, I need to think about this. I need to talk to my accountant or my lawyer or my investment bank or whatever it is. I should say, in terms of how we're going to go through this material, I'm going to be running through a lot of the slides myself, but we're all going to take turns. Each of the panelists will have at least a couple of slides where they will be sort of taking the lead as we go through. And then once we've gotten through the first pass on the content, then the rest of the panel is just going to be jumping in with comments, war stories, and the like. Okay? So here are the topics we're going to cover today. I'm not going to read them, but I'll leave you to read them for yourself for a minute. As you can see, it is a lot of material. So let's start by talking a little bit about where we're going. The final stages of an acquisition. Let's take it from the identification of the potential purchaser. So you're out there, you're marketing the company, or perhaps you get a term sheet that lands in your inbox. This is the stage at which you're within weeks or months of closing a transaction. So there's a process back and forth. It may be an auction in which there's a process, perhaps handled by an investment banker, to determine the best potential buyer of the company. Once a purchaser has been identified, you'll go to the term sheet stage, which is a document of probably between 4 and 10 pages that outlines at a high level what the business terms are, price, structure, is it an asset or a stock deal, is it the entire company or certain elements being left out, are there any particular terms with respect to employment agreements going forward. Once the term sheet has been signed, we get to diligence. For those who are not familiar, that can be a long and excruciating process whereby the potential buyer will want to know everything about your company and about you. The request list for diligence in and of itself can be 10 pages long, and there will be 15 to 20 items or more on each page. So they will want to know about all the legal affairs of the company, financial affairs, financial statements, potential litigation or actual litigation. They'll want to know about employment matters. They'll want to know about all of your contracts with your customers. They will want to talk to your customers. They'll want to know about environmental issues. The list goes on and on and on and on. And it can take many weeks, if not months, to get through it. And it is, in many ways, a dangerous time in the process for you as a seller, because this is the point when bad news comes up. And this comes up after the term sheet has been negotiated and the price has been set. So you will find that your bargaining power tends to be at its highest at the term sheet stage. And after that, it diminishes rapidly. So the diligence process, as bad news comes up, that is what affects the purchase price and drives it down. So one of our goals here this evening is to sensitize you to the issues that come up at the diligence stage, so you can have everything ready beforehand, and so there are fewer surprises, meaning a higher purchase price. Okay? And then we come to documenting and closing the transaction. That's when the lawyers particularly get involved, writing the documents that document the term sheet terms, and then actually closing the deal, which is when money changes hands, title of the company changes hands, and everyone hopefully rides off into the sunset. Factors that will influence the outcome. Knowing when the time is right, that is, knowing when the time is right for a sale, either both industry-wide and for your company. Knowing who your potential buyers are beforehand. Knowing and being able to deliver what they're looking for. What are people going to be interested in your company for? Is it your employees? Is it your intellectual property? Is it your customer base? Is it your product? There are all sorts of assets at play in a transaction, and it's important to know what people are buying and to be able to deliver that. A smooth process, as I said, is very important, and timely financial planning. As I mentioned, and the overwhelming theme of this presentation this evening is that you need to focus on these factors long before the exit. So I've just done a lot of talking. I'm going to turn it over to my colleagues to see if they have anything to add at this point. All right. Tony, you have anything?
Well, the only thing I would say is that the cleaner your company can be, you should be planning for an exit strategy from day one. Because if it's a clean company, it'd be a well-managed company. Try to stay out of personal debt. Try to stay out of things that entangle you. Just have a very simple mission and try to keep it very clean. If you're planning to sell it or at some point, don't have to ever sell it, but if you're planning to sell it, it'll be a cleaner company and easier to manage and better, more valuable in the marketplace.
All right. Okay, so first topic that we're going to hit, entity and jurisdiction. So in a sense, this goes back to the very earliest stages of your company. What type of company are you forming and where are you forming it? And these, so again, long-term planning. At the instance of formation of your company, you should be thinking just a little bit about what the end game is. Now, back in the day when I started practicing law, we were primarily forming corporations for companies, both early stage and established companies. But over time that's changed. These days I do a lot more LLCs. Although for technology companies, there still tends to be a predilection for C Corps. Now, I think this is perhaps one of the first issues that you think about in your company, and it's important to give it some thought and to discuss it with your advisors, because while people will, there are all sorts of reasons for going one way or another, it's important to know what the factors are that make a difference. There are significant tax benefits to being formed as an LLC. So if you are expecting that you may be able to get to an exit, get to a sale without taking VC money, and then you should consider forming as an LLC, and you may want to stay as an LLC. It gives you a benefit in terms of flow-through taxation, enhanced ability to deduct losses, and upon an exit, you may get, or I should say the buyer may get, more favorable tax treatment through a step up in basis, which is getting a little bit complicated, and Mike may have some more to say about this. But suffice to say, there are meaningful tax benefits to running your company and exiting your company as an LLC. So I often advise my clients that unless they know that a VC investment is imminent, to start as an LLC, because it's relatively easy to switch from an LLC to a corporation. It can be quite difficult to move the other direction. But there are difficulties, as I noted, in the LLC form. Venture capitalists will generally not be willing to invest into an LLC. Foreign investors, similarly. and there are more complications in terms of equity plans and other issues. Mike, do you have anything to jump in at this point?
Yeah, thanks, Paul. I do think that the LLC has a great deal of flexibility associated with it and advantages that a corporation does not have. As Paul pointed out, an LLC can take the form actually of a corporation for tax purposes. So a corporation, as you know, is subject to 2 levels of tax. I don't know how many of you who are entrepreneurs who have smaller companies already have formed your enterprise as a corporation. Okay. So if you're a C corporation, that means that there is a corporate level tax that the corporation pays, and then the shareholders have a second level of tax. So it's a double taxation system for corporations. And what Paul is saying is that an LLC allows one to be taxed at a single level, so that it's viewed as a flow-through entity, and the owners of that company receive a single level of tax at the owner level. That's if you elect to treat, or you allow the LLC to remain as a flow-through entity. It can also be treated as a corporation. It could be subject to double tax. It could be treated as a partnership where individuals or other entities can share in that. And it allows for a lot more flexibility of capitalization, equity. And what we're saying is that on disposition of the company, because you have this single level of tax typically with it as a form of a flow-through entity, there will be a single level of tax on the exit. And that's a very good thing. Typically it's going to be capital gains tax to a seller, which is a very low rate. For the buyer receives a step up in the tax basis of the assets of the company based on the purchase price that was paid for the LLC. Whether it's an asset deal, whether it's an equity deal, they're still going to get this step up. And that's a great thing for the buyer because it provides a tax shield for them going forward to offset the taxable income that the acquired entity will throw off in the future. So that's a real advantage that a seller can use to promote the value of their company from a tax standpoint. Yes?
Could you talk about S corps also?
Yeah, I'd be happy to. Yeah, an S corporation, it's interesting, even an LLC can be an S corp. So it can be a C corp. It can be a partnership. It can even be an S corp. You can take an LLC and file an election to treat it as an S corp. An S corporation is treated a lot like an LLC. It's a flow-through entity. It experiences a single level of tax at the shareholder level. Now, that's true for federal income taxes, but there are state taxes that could apply to an S corporation and to an LLC. I forgot to mention that. But you can have entity level taxes that could apply to the ongoing operations of the company. And on exit, you can also have a step up in the tax basis of the assets of the S corporation as you do with an LLC. There's an election that you can file to do that. There are a couple of them now, where the buyer, whether it's a corporation or whether it's an LLC, regardless of its format, it can actually step up the basis and the assets of the S corporation and thereby create that tax shield that we're talking about with the LLC. So there are many comparable benefits to that as well. There are restrictions that an S corporation has, however, that an LLC doesn't. So that's why the LLC presents a great deal of flexibility. An S corporation, in order to maintain its status, has to meet certain requirements. Not only just file an election to be treated as such, but it has to maintain its qualified status. It can only have a single class of stock. It can only it can't be owned by certain trusts. Partnerships and corporations can't be shareholders. Also, you can only have a limited number of shareholders. So the S corporation is a vehicle which is very, very good and promoted by tax advisors, but the LLC I still think provides a lot more flexibility. Yeah. Yes.
Can transaction fees like broker fees, legal fees, be used as a tax shield for the seller?
Yes, the seller does incur its own transaction fees, and it can be used to reduce the amount realized on the sale, whether or not you do an asset deal or whether you do a stock deal. You can use those to offset your gain, typically. It's usually on the buy side where you have the issues of whether you need to capitalize those amounts or whether you can deduct any of them, whether you can amortize them. Okay.
So it sounds great. So why do VCs and foreigners not like LLCs?
Okay, well, that's a good point. If you are a foreign investor and it's a partnership, there can be withholding taxes that apply on distributions from the LLC. So that might be an impediment to them. Venture capital firms, I would still think that they would be interested in LLCs, and it might really come back to the other legal issues that Paul was mentioning as to why they might not like.
Often what happens with VC firms is they have limited partners that are unable to invest into a pass-through entity, and so that just for that reason the VC firm is simply unable to invest into an LLC. That's changing a little bit, but I don't know, Dan, if you have any thoughts on that?
No, I think that's pretty consistent.
Yeah.
If it's changing, it's not changing a lot.
Not changing much, but there's, I mean, I have seen some instances where you'll see it happen, but take it as a rule that a VC firm is not going to be able to invest into an LLC. So, all right. Delaware, generally your best choice as far as jurisdiction, unless there are certain particular things that apply, like you're running restaurants, you need a liquor license, or it's real estate, or there's certain areas where you may want to be organized in New York, but otherwise you should be organized in Delaware. Consider segregating your different lines of business early. I have several clients that are, they have a technology that's applicable to different verticals, or they're developing different products, and they're thinking about early on dropping their products or their different verticals into different entities, which makes it easier if they want to sell a certain line of the business. Something to think about. But the bottom line, in these issues, you certainly want to at least discuss it with your lawyers and with your accountants to make sure you start with the right entity in the right place. All right, founder relations. It's important to give proper attention and proper timely attention to what's going on among a founders group in the beginning. These, it may just be 2 or 3 or 4 people. You're all in this together. Everyone's on the same page. That's how it is day one. Things can change very quickly, and as I'll say several times during this presentation, time is not your friend. You should nail things down in the very beginning while everyone is still aligned and on the same page and marching forward in lockstep. Because as soon as things start to get better, as the business develops, there's more money involved, you have investors interested, whatever, there can very quickly become a disalignment of interests, and you want to have things tied down before you get there. The things that need to be addressed: what are the equity percentages among the founders? Reverse vesting. Is there going to be? Are you all going to have to earn into your equity over time? Titles and roles, and buyout rights. If someone wants to leave the company, what's going to happen? Again, the way to avoid problems: get to it early. Do not delay. get everything in writing. At some time before you get too far, you're going to want a proper shareholders agreement. I am seeing these days that as companies are starting quicker and cheaper, they may decide to go without a shareholders agreement in the beginning and go with the majority rule. They will in that case, they'll certainly want some transfer restrictions and other things built into their bylaws. But that's only for the very early stages. But before you get too far, you'll want a shareholders agreement. Any thoughts, Mike, Tony? No? All right. Dan, I will turn this one over to you. We're up to industry intelligence.
Yeah, this actually, I think, dovetails very nicely with what was said before about planning for the exit. The good news and bad news in industry intelligence is that the information is more accessible and more complete than it's really been ever. The sources of data, of market intel, of research analysis, public relations are huge these days and usually free of charge. The bad news is that the information is also changing almost perpetually. And so, to the extent that you're planning for an exit, it's more challenging than ever to really know who your exit target is going to be, because the strategies of these exit targets are in flux. And they're more in flux now than they've been probably in a very long time, and probably ever. So for instance, when Oculus started, I doubt very much that they were planning to have an exit to Facebook. Nobody would have expected 3-4 years ago that Facebook would be acquiring a virtual reality technology company. Buddy Media a few years ago was also pretty unexpected in terms of who the buyer was. With hindsight now, a lot of these things might seem obvious or at least explicable, but when you're planning forward, it's very, very difficult to do. And so, with all these things in mind, I think you would be well served. And, this may sound self-serving, but I mean it very sincerely, because you're all managing a business, and that's what you have to be focused on. It's the job of a financial advisor to keep an eye out on what's going on in the industry, the changes taking place, the trends that are happening, who's participating, who's changing course, and why. So you would be very well served to develop a relationship with a financial advisor who's very much on top of these informational trends and the industry intelligence, and probably now more than it's ever been.
All right. Dan, I think this one's also for you.
Yeah, this is a related topic. It used to be more straightforward than it is. Building value, you look at EBITDA multiples, you look at revenue multiples, and you plan, for those metrics. And as your business grows, you try to optimize for those types of variables. In light of what I just said, which is a very, real change happening, a lot of what is value these days in the enterprise is, for lack of a better word, option value. Meaning, in technology especially, it's very difficult to anticipate what the business will be 3, 4, 5 years out. And so therefore, the typical DCF terminal value, which often constitutes maybe 70 or 80% of the overall valuation in the classic scenario, nowadays is is much more problematic, because who knows what the business will be 3, 4, 5 years out. So how can you really measure that terminal value with any kind of confidence? And so in practice, the value at the terminal point really is optionality for a lot of technology businesses, meaning it's the possibilities that such an asset can lead to over time. Maybe if it's a analytic tool that's currently used in advertising, over time it could also evolve to be used in financial services. If it's, along the same lines, if it's a trading technology in financial services, over time it could quite easily be transformed into advertising technology. And in fact, nowadays that's happening a lot. So building value in the enterprise in this type of volatile environment really means keeping your mind as open as possible to possibilities that you would probably not have considered, under different circumstances. And buyers are very mindful of those possibilities and valuing your businesses with those possibilities in mind. I don't know if anyone has questions along those lines.
I'd like to just make just a couple of comments to add on to what Dan has just said. A couple of examples. Recently, one client came to me. We were talking. He's seeking investment, and he said, I was building the system to solve this problem, but in order to do that, I had to solve this other problem along the way. And as I've gone through this, I realized that this other problem is really the big market opportunity here. And what I originally sought to do was just one application of this much bigger, this much bigger system that I built. So I think that goes to Dan's point that you may find that along the way you stumble upon a much bigger opportunity than the one that you're actually looking at. And another thing I'd say, a few years ago, talking to a client that was busy, building, towards an exit and talking to potential acquirers, and he said, what's frustrating to me is that I thought that what was going to matter to my buyers was how broadly I had expanded my company, how many cities I'd launched in, and they don't care about that. They care about how good is my technology, and so all this money I've been pouring into launching into new cities, I might as well have been, perfecting my technology. And so this is an example. There's so many things that it can be they're buying your cash flow or your IP or your customers or your employees or some of those or all of those or other things that aren't even on this list. And so what's really important for you is to think, for every company there are different sorts of buyers. There are financial buyers, there are strategic buyers, and strategic buyers will be buying for different purposes. Think about what it is that they're buying, who the most likely buyers are, and making sure that to some extent you're keeping that in mind as you build the company. So if you know that Google is a potential buyer and you have some idea why they'd be buying you, make sure you're building out in that area, because that'll maximize your purchase price.
Yeah, just to add to that, now there's an interesting trend going on, which is that corporate buyers are increasingly coming in as substitutes for what would ordinarily be a follow-on venture capital round. And so as the VC community is consolidating and the funnel is getting tighter and tighter for later and later rounds, the capital is getting harder to raise for a lot of companies. But the corporations are coming in to fill that void. And in those cases, these corporations are in fact acting like a VC. What they're buying is really a venture stage business. And they're perfectly content to do that because what they're buying is in fact an option. So examples would be, Yahoo, for instance, which is buying about, a company a week these days. And these are all startups. These are all companies that under other circumstances maybe would have raised venture money, but are instead selling to Yahoo, which is building up an option pool of these various technologies. And so that is a very clear trend that's going on these days, where M&A is in fact a substitute for capital raising for certain companies.
So is that the exit?
Yes.
When Yahoo buys a small startup?
Yeah, it is. And
So the owners are at that point saying, all right, I've built it enough, and I'm not going to appreciate any of the additional growth.
Yes, I mean that's the implied message.
Okay.
Actually, to his point, does Yahoo get involved in management and kind of owns the company and consolidates it, or does it, as a venture capital, just give you the money and let you run with it, that type of thing? So is it acting as a venture and letting you go, or is it basically buying it and then consolidating it?
I mean, in Yahoo's specific case, but these have all been very different. But in their specific case, what they've tended to do is hold on to the teams that come with the business that they buy. They often repurpose these teams to build different technologies. Not always. And so to a large extent, it's also a talent acquisition. But they do take the technology, and they want to have the technology that they buy. But what they do with that technology, varies with the opportunity.
Can I add to that?
Yeah.
When a public company buys a private company, we see two distinctly different styles. Sometimes they'll buy the company and pull them into their corporate culture. Maybe the purpose is to keep the technology away from a competitor, but eventually what they'll do is the original company will maybe disappear and just become immersed within the buying company. The biggest transaction I've seen and been involved with was when Amazon bought Zappos for $900 million. The only reason Tony Hsieh said you can do it, or I'll sell to you, is I want autonomy. I don't want you to fire anybody. I want to do it our way. We'll be part of you, but we want to remain as independent as we've been before that. But they needed the money to continue the expansion. So they got new capital, but they remained independent for operating purposes. So it can go both ways. But it also depends on the deal structure, because oftentimes the selling entrepreneur maintains equity. So he has that upside. So it's not just a cash deal.
Another pattern is having innovation teams in major public companies maintain portfolios of early stage technology companies. Bank of America is doing that.
Yeah.
I'm kind of curious what you've seen in terms of companies engaging bankers, not engaging bankers. Do you think there's always a significant amount of value that an investment banker brings to extract maximal value? Or do you think it really kind of depends on who the banker is, what they know about the industry in particular, and the particular situation, as opposed to, can you go, does the iBanker always bring the value, or can you just use a transactional layer if you have a good sense of what you think you're worth?
Yeah, I mean, as I said before, well, first of all, yes, it very much depends on the banker. And what I mean by that is, in the environment we've been talking about, it's no longer really an auction process. The types of businesses that are sold don't really lend themselves, to a structured auction, usually. I mean, I'm generalizing now.
Because it's not just pure eBay.
Yeah, and also because the nature of the asset is not so structured anymore, so one technology could make sense to Bank of America for one reason, and it could make sense for Google for another reason. The same technology, but it has to be positioned in different ways. And these two organizations would value it in different ways. So all these things need to be explained properly, and the process, is much more complex now than it would have been 10, 15 years ago when you were just selling, a cable system or a magazine. That's very well defined. I think the value of a banker is not only transactional, though, but really strategic. And for the reasons that I've been describing, because the environment is very, very complex. It's getting more complex all the time. And CEOs are not there to monitor a complex environment that doesn't help them to run their business. CEOs should be there focused on their business, which means that by definition, they will not be paying attention to external variables that could become hugely important later on. That really is the value of having a banker involved.
Just one follow-up, and this is just my opinion. I think generally speaking, private equity is incentivized to be the low bidder because they're working for their investors. An investment banker is working for the company and incentivized to get top dollar for the business owner. We had a situation a year ago where we were introduced to a family that was about to sell their company. They were very impressed. Private equity came knocking at their door. And they had two private equity firms that were interested in them. And they thought this was the best. They were going to sell their company for $40 million, and they hit the lottery. We called a timeout. The private equity guys got really mad at us. We introduced them to an investment banker, had an auction, sold the company for $62 million. They needed it. It was part of a roll-up. It just fit perfectly into what the buyer wanted to do. And it's those kinds of transactions that bankers truly add value in. So it depends on the industry, it depends on the transaction. More often than not, an investment banker is going to create an auction for your company and find you the best buyer. So,
one more question, then we got to move on.
So, as you said, as a CEO of the company, I'm very much focused on building my company. So the exit is going to be 3 years out. Is there an advisory practice, because I won't engage with the bankers or anybody 3 years down the lane. As Paul mentioned, it can be what buyers may look for, my customer base, they may look for my employees. I don't know what they're looking for, right? Is there an advisory practice out there we can engage from now on? Can serve as an advisor and say, this is what the market is trending, this is what you guys should be focusing on. We don't get distracted from our original mission, but who guides us with that? I'm sure the M&A firms get engaged at the last minute when the transaction's about to begin. But from now, this point on to the next 3 years or 5 years, whom would you advise entrepreneurs to go?
Well, I mean, I'll tell you my preference, which is to establish relationships early on. It doesn't have to be transactional, but establishing a long-term dialogue with even a prospective client who is not an actual client today is very valuable, both for the banker and the client. So when the time comes, you can hit the ground running. And by the same token, the banker will be intimately familiar with the business that's being sold. And I think the best bankers take that approach and have that long-term perspective in mind.
All right, so we're going to have to move on, but I think, I would agree. The answer is a banker, most bankers would be happy to speak with you a couple of years out, and it'll be just a light touch in the beginning, but to give you some advice along the way to help make sure you're going in the right direction, so that, as Dan said, when the time comes, you're ready to rock and roll. So, but I think that generally speaking, we'll talk about advisors again further. I mean, that goes for your accountant, that goes for your lawyer also. Those are relationships it pays to develop early out, so that when the moment comes, you're working with someone who knows your finances, who knows your corporate structure, who knows how the company works and the customer base and your contracts, so you're ready for diligence and ready for everything else. So, all right, Tony.
Yes.
This is to you.
Is that my original? Good. All right. I get to talk about where the fun is. If you're going to sell a business, it's because it's got revenue. Bingo. So where does revenue come from? Well, in my experience, and again, I've done it on my own, I've done it as a profit center, and I've done it as corporate, publicly traded. It comes from customers. It's not about what you want to sell. It's about what your customers want to buy. So I just have the basics up here because that's pretty much what went through all three of the entities that I was involved in. Good reputation, credentials and brands, satisfied and profitable customers. Brand is worth about 30% of your value. It's often characterized also as goodwill. Warren Buffett says it takes a lifetime to get brand and good reputation. You can lose it in an instant, and he's right. Second, recurring revenue. It's not just one-off sales. You've got to have recurring revenue to get a good price. If it's from product sales, you've got to have distribution. The wisdom is that small companies build products and services to get distribution. Big companies have the distribution, and then they find products and services to go with it, to expand and support their brand and their distribution. For services business, you've got to have a recurring need on the part of your customers. It can't be just a one-off. For example, if you're doing a SaaS business, there's something called the customer acquisition cost. It generally takes about a year to 18 months to recover the cost of getting a good customer, because some are going to fall out before you get done. So if you're going to be in the SaaS business, you've got to understand what your cost of customer acquisition is. For B2B customers, you've got to make sure that if you're in the B2B market, you're selling to other businesses, you've got to understand what the unique bottom line advantage you can give them that they can't get anywhere else. Otherwise, you don't have recurring value. For consumers, it's an enjoyable value. I don't know if using Intuit is enjoyable, but it's certainly more enjoyable than about any other way to do your taxes. Just to insert, it's not up there, you want to sell a company when the value is going up. That means that every month that goes by, your position gets stronger and stronger. There's a disease called entrepreneuritis, where it's never the right time to sell your business. If the business is doing better and better, it's not the right time to sell, we're making money, let's hold off. And if the company is not doing well, then we can't get the price that we want for this, let's not sell it now, let's wait until we rebuild. The time to sell is when the business is doing well and getting better and better. Everything has an end, nothing lasts forever. You might as well have the time work with you. My formula is you don't sell or build a business from what you can do well. You build a business from what the customers want to buy. Where do you want to be? What problem do you see that you're going to be solving that's going to lead to good brand and recurring revenue? Then you work backwards. The reason that you do that is if I'm a programmer, I'm going to try to come up with a programming business. I won't see where the holes are in my skills. But if I look forward and say, okay, this is a solution that my customers want, and I know I can sell it. Now, and I work backwards, what do I need to develop to be able to provide that? Now I can see the holes. Now I can see the skills I need to buy or develop or what have you, or whatever it is, and I can put a price and time tag on those to see what it's going to take to develop them. Always work backwards from where you want to be, not forwards from what you've already got. Target at least a 50% gross profit. That means if you're getting a dollar from it, it should only cost you 50 cents at most to generate it. You've got to pay for the lights, you've got to pay for people, you've got to pay for your rent. You're going to end up, if you're doing well, with at least 15% net. That's what you want to have. There's going to be ups and downs. Make sure you're getting at least 50% gross profit. 60% is even better. You want to successfully sell your offerings before they are finalized. What does that mean? Well, I see a lot of companies that will develop a product, particularly in software, where they develop version 1.0, use up all the money, and then let's go to market. Well, they have no money for marketing. I say, and this is something I've always done, is you take a product or service, and when it's just serviceable, not perfect, then you go out and sell it. And what do you get from selling it? Well, you get your customers' reactions. They're telling you what's wrong with it. They're telling you what they really want from it. And you're pretty smart, so you're going to be able to fix it quickly. And now you're starting to get happy customers, and you're building credentials. And credentials are gold. Money comes and goes, but credentials are gold. They never stop paying off. You've always got your case studies. You've always got your references. It's a great place to be. And you've actually even made them a little money with it. So now you can go back. Now that you know what your product is in the marketplace, and now you can start building a company based on that. So you start first by figuring out where you want to go, and then when you figure out what you have along that line, go out and sell it, and then finalize the product or service. Don't wait till the end when you've run out of money. Finally, no matter what you provide, service, product, doesn't matter. Bottom line, you are in the relationship business. Your products and your services are only ways to build relationships with customers. And you want to build relationships with customers that are worth having, that are worth investing in. At the end of the line, if you have a product or a service that's okay, but your customers love you, you'd be better off when it comes time to sell it if you are doing a perfect job, but everybody hates you. So you're in the relationship business. The products and services, the problems that you solve are really only methods of building marketable relationships with your customers. That's it. That's it for me. And that's what's worked for 3 different businesses in 3 different venues, doing pretty well.
All right.
Any questions? I should ask that, actually. Sorry.
Question, we can take one question.
One question.
Just that last point, do you have like a story or example on where you had something that was less than perfect, but they like you? Is that sort of like a services business or?
Well, for the present, what we're doing. We had a client, a $400 million trucking logistics holding company. And they wanted to use our service to find out what good markets they were out there so they know how to reorganize, because they just took it over. And we went in there and we delivered some of our data that on their markets, and we showed 8 million interested searches for freight companies, shipping companies, trucking companies, flatbeds, riggers, what have you. And we thought this was great, because we know what the closed sales are going to be, at least 1% of that. So 1% of is 80,000. Is 80,000 closed sales. And the client took a look at this and said, that's garbage. Why is it garbage? Well, the reason your number of searches is so high is because these are freight brokers. And they're on the internet all day long, playing poker. They're trying to find the best deals they can. But over here, we have 7,300 searches for warehouse supply chain management consulting. That's interesting to us, because only big companies want it and only big companies can supply it. And if we get 1% closed sales on that, we make $100,000 net. That's $7.3 million. That's a good ROI from this service. So that would be an example of they liked us, they liked what they brought. They didn't like the initial result, but it worked out okay.
All right. I'd say both the panel and the audience, we're going to have to move a little bit faster. So it's all good stuff. It's just there's just not much time. All right, Mitchell.
Perfect. We'll speed it up. Just big picture macro trends. When I started out in this business, companies were being built with the eye towards transferring it to their kids, grandkids, keeping it in the family for generations. And over the last 15 years, we've seen that more and more companies are just being built to sell. They're being started with the end game in mind. So with that as a preface, let's just say that every decision you make is going to affect the future sellability of your company. It's critical that you surround yourself with the top, best professionals you can. I've heard horror stories where the college roommate incorporated the company, did the real estate transaction, and now is negotiating the sale. You can't do that. So you have to really identify professionals in each silo, get close to them, and let them help you navigate the waters so you have a successful sale. You have to remember, you're doing this for the first time. Whoever's buying your company has done this hundreds of times. So you're outmanned from the get-go, or you're at a disadvantage from the very start, and that's where a key advisory team could certainly help. Audited financials, critical. Proper wealth transfer strategies to keep the state taxes down. The government's your friend in a sale. If you do the proper planning, you could minimize the amount of money that goes to the government. Make sure that when you sell your company, if you have a non-compete, that you're going to get enough money to maintain your standard of living. It sounds sexy when you could sell your company for 5 to 7 times earnings, but if what you're left with isn't enough for you to live the rest of your life, then you didn't really do a good job. So you always have to make sure that you have enough when you sell. Post-sale, for those that get there, the way we view it is there's 2 buckets. The first bucket replaces the company you sold. That's going to generate the cash you need to live your life. The other money is your legacy money, philanthropy, kids. Do what you want with it. If it disappeared, your life wouldn't be different. We've done this over 200 times with people. There's no shortage of war stories, but we won't share them now. So mistakes are expensive.
All right. And then we've got another slide.
Forget the next slide if it puts you to sleep. It's just basically money saving strategies. Talk to your accountant. Once again, mistakes are expensive. So that's where your advisory team can help you. Oh, and just a plug to the lawyers. You might have a generalist as a lawyer. Anything you read in the first 5 or 10 pages of a document is not going to hurt you. What will kill you is on page 80, and your guy didn't read that paragraph. The buying company's attorney wrote it, and you lose. So you got to work with an M&A attorney who knows what he's doing. Like Paul.
All right. Well, outside advisors, I think we've pretty much covered this. The only thing I'd add to what we have discussed is getting the right person. There was a question about investment bankers, industry-specific expertise. You should get someone that really knows your space. Right size. Speaking for lawyers, you want neither a solo nor do you want SCAD and ARPS. If you're a small to mid-sized company, you want a company. You want a law firm for whom you will be an important client, and they will want to answer the phone when you call because you're important, but not so small that they can't manage the deal when the time comes to sell the company. So there's sort of a range you're looking for, and that they're going to be there for you. They're going to be there to offer their time and assistance at critical moments. So for all the professionals here, it's finding people. If you're a technology company, make sure you're working with an accountant, a lawyer, a banker, or someone like Mitchell, an a wealth manager who understands the technology space and who has done these deals many times.
I appreciate the importance, especially with a lawyer, to have someone who's a specialist in the area of M&A. When talking in reference to M&A, how important is the accountant?
Well, I think that's a great segue to the next slide.
All
How's
right.
that? Should we move
There we
on?
go.
Thank you. Let me answer that for you. Thank you for the question.
We planted that question.
Right. Well, I have to say that I really think that accounting is extremely important in this whole process. You've heard the references to it, and why? Why is that? Well, I divide up generally buyers into two categories. There's the strategic buyer, and then there's the financial buyer, right? We've been talking about venture capital, private equity. These are all of our financial buyers. And for the most part, these companies are really looking for a company that's going to grow in the future, of course, but hold it only for a certain period of time. So they're really focused on quality of earnings, okay? The strategic buyer is looking at synergy as well as earnings and holding the company for a long time. But I bring up the financial buyer especially because in their case, they're not only going to be looking for financial statements that are well equipped to tell them the story, but they're also going to be looking for someone to describe and provide credibility to the quality of the earnings of the company so that they can determine their multiple and therefore the purchase price for the company. Okay, so when we talk about an army of people coming in, where you need to have individuals, advisors there for you, the army of people that are coming in are very focused on these numbers. And if you're not in a position to respond quickly and with credible information, having it ready, it'll slow down the deal, it'll diminish the value. I know that Paul's been talking about that. After the letter of intent is entered into, the value only goes down from there. And the reason why is because the financial information that's presented needs to have a lot more certainty associated with it. And that's where the accountants come in. And I will have to say that you can't find anyone who wants to be more of a trusted advisor with independence associated with it than an accountant. That person, is wants to be your partner, wants to be, of course, with independence in mind, wants to see your company grow. He wants the right things for you according to GAAP, according to appropriate accounting policies that clearly reflect income. That person is there, as someone who I think can be trusted. And there are things that are done by accounting firms that are just different than putting together, financial statements. They do provide another service that you might call sell-side due diligence. They ready the company for that. The investment banker is very important in the whole process, of course, but I think that the accountant can also provide, deeper, a deeper analysis of what's being presented, for example, in the offering memorandum, and can help the company respond to questions. So I hope that's responsive to you. Do you?
Yes. I have a lawyer who's in the M&A space, and I asked him, should I have an accountant with more experience in that space? My lawyer said, nah, he's fine.
Wow.
And so I'm an early stage, fast growth company. I totally appreciate the importance of an experienced accountant in this space for a more advanced company. I guess I'm selfishly curious about smaller companies, if it is still as applicable.
Can I add? I plug professionals my whole life. We had a situation about a year ago where a company was for sale, the financials were presented, and the private equity guy that happened to be looking at this called me and he said, I can't buy this company. This is just, the numbers don't work. We took it, showed it to another accountant, reworked the numbers because they were just presented, they weren't done the right way. I don't know that much about accounting, but the bottom line is the way these numbers were presented, the company didn't look attractive. If you have an accountant who knows what the way buyers want to see their numbers, they could be presented in a much better light, because not all numbers are numbers. It's not just putting numbers in boxes. There's restating earnings, normalizing cash flow. I mean, for example, you might pay yourself $500,000 a year. That's great. You have less earnings. But if someone bought you to replace you with a real operator, could probably do it for $250. That extra $250, you're going to get a multiple on. So you have to normalize all of this and present it to a buyer as though this company was operating independently from a non-owner operator. And if you work with an accountant who has experience, your company will have a better light and be more marketable.
That's a terrific point, because what buyers are looking for are those adjustments to EBITDA that are going to decrease the value of the company, whereas if you have someone who's experienced on the buy side doing some sell side work for you from the accounting standpoint, they'll help you identify items that will help your quality of earnings look more attractive, as well as just the overall balance sheet and income statement that you're referring to. So the value that can be brought is extremely important. Now, in the smaller company space, mid-sized company space, maybe the growing company space, audits might not be that frequent. There might just be reviews taking place, compilations. Those are fine, but a word of warning to everyone, a cautionary note, is that when the buyer is going in, from the financial statement standpoint, they're usually asking, as you said, is it audited? I mean, that's really critical. And if it's not audited, then if you're in a disposition mode, you might be thinking about upgrading, your accounting services to the level of an audit to prepare for that, and have that prepared over a couple of years before you're going to go put yourself on the market.
Are you done with that slide, Mike?
Oh, we're done. Yeah, with the accounting part.
Okay.
So I know we need to keep moving.
Are we, this one, next slide, Mike?
Oh, right. Just a couple of notes on this slide. There are a couple of really interesting points here. For one, I just wanted to mention that in this industry, there are a lot of important things that are going on that you should be aware of in terms of research and credit, research credit, and other matters. But when we're selling a company, buyers are interested in tax attributes. So those kinds of credits, if you were a startup company and you're throwing off a lot of tax losses early, a buyer would be interested in that. Those are valuable assets that a buyer will view very positively. They're generally subject to limitation, in connection with an ownership change, but there are things that can be done from the tax standpoint to help present them in a way that they do become usable by the buyer. So keep that in mind. The other thing here is that you might not want to have a complete exit from your company, so we'll call that a rollover. And there are ways of doing a rollover so that it's tax-free to the seller. You can take a continued investment in the acquiring entity, and there are ways that we can get you to that position. One of the things I'm finding too, real quickly, is IP. I know you're all interested in that. A lot of that, there's a lot of operations that are moving offshore. So from an accounting and tax matter standpoint, one of the biggest issues that comes up is transfer pricing and intercompany transactions cross-border. There can be a lot of exposure there, so you might want to give consideration to transfer pricing studies so that you can ameliorate possibility for that being an exposure area in due diligence. Yes?
I was just curious about profit interests in LLCs. Those are awarded to consultants. They're essentially equity interests of the profit from that day of issuance going forward, so it avoids the tax issue by receiving equity in the company. I saw a situation where a company was converting from an LLC to a corporation, and the person who had the profit interest was told that he wasn't worth anything, and they had nothing, even though they had given services to the company. They were basically shut out. So my question is that seems to be a danger with profit interest. Is there any way of avoiding that? Or can you discuss that issue? I mean, because it seems like a real fatal flaw to profit interest.
Right. I would think that where you have a profits interest in that regard, it's a lot like having, taking sort of a phantom stock interest in a corporation where it begins to build in value. So the value of that profits interest is really going to be dependent on the value of the business growing. I don't know what they meant by it was worth really nothing. He didn't have a capital interest, certainly.
No, he had a profit interest. And
right.
It had been issued a year or two early, and they decided to convert to a corporation from an LLC because investors wanted that.
Right.
And it just happened at the time of that conversion, there wasn't any real value in the profit interest, so they basically got nothing. They were shut out of the conversion.
Shut out. Okay.
I mean, unless I'm reading this wrong, I mean, it seems like a possibility, and it seems like a real Achilles heel to the whole process.
They didn't retain any interest in the ongoing entity, in the ongoing
According to
entity?
what they were told, they didn't, and And they valued it at the moment of the conversion, it was worth nothing.
That's more of a business issue, I think.
Just
than
wondering.
anything, so, yeah.
Yeah, we're gonna have to move on. The one thing I'd say on that point is, I'm surprised at that result, but I will also tell you that when I'm working with LLCs that are contemplating a conversion at some point to a C Corp, I tend to avoid profits interest because there are all sorts of complications that come up at the point of conversion. I wouldn't say we never do it, but we think twice about doing it. So, all right, so we're going to have to move a little more faster still. Corporate housekeeping. I'm not going to spend much time on this. Just to point out, if you do it timely, it's easy, it's cheap, and it'll avoid a lot of complications afterwards. All it's holding your regular meetings, documenting your actions, properly issuing your equity with proper documentation. But if it's wrong, it can be real messy afterwards. I wouldn't say I've ever seen a deal that got blown up over corporate housekeeping, but I'll tell you what does happen is that when the buyer comes in, they start looking at the corporate records and everything's a mess. Like actions haven't been properly authorized and they don't have proper documentation for the equity. And they say, this isn't too good. And they start digging deeper and they start scratching a little bit further, and then they start finding stuff. It slows down the deal, it reduces your purchase price. So tie this stuff down in the beginning if possible, but certainly before you get to diligence, okay? Shareholders and their rights. We talked a little bit about shareholders agreement. As I said, companies don't necessarily, these days in my experience, have a shareholders agreement in the very beginning if they're like a pure bootstrap startup. But as soon as you start to get some traction and have some money, you really must have a proper shareholders agreement. There are things that are going to matter hugely when it comes to an exit. Drag along rights. You don't want to have one or two shareholders, minority shareholders, that can be a holdout preventing a sale. You may need supermajority override to get a deal done or to get various things done along the way, to get an investment done. If you don't have a shareholders agreement or similar documentation, or don't have those rights in your LLC agreement, then you have certain individuals who can be a holdout on getting a deal done. We've talked a little bit about strategic investors. Often companies along the way will take strategic money in lieu of VC money. There can be a lot of benefit to that in terms of contacts, expertise, credibility, but if you have a strategic investor in the mix as a shareholder, that can reduce your exit opportunities. That doesn't mean you don't do the deal with them, but you just keep in mind that the industry may perceive that your company is captive of X strategic investor, and the other big players may be disinclined to bid on your company as a result. So, we will move on.
Just one
Yep.
tiny point.
Yeah, please.
In the same section, also for VC-backed projects, be very careful with liquidation preferences and what they mean and how they impact the value that you ultimately have. The cascade and the capital structure can sometimes be so complicated that the value that you think you have received or built in your business is actually not it at all, when all of the senior ranking securities, which are in fact venture capital investments, collect their piece of it before you do. So for entrepreneurs especially, venture capital is a form of leverage because it does rank senior to where you are. And so that's something very important to bear in mind.
Yeah, absolutely. Contracts and particular provisions. So these are the contracts. We're talking largely about the contracts in the course of running your business with customers and vendors and strategic partners. There can be a tendency to do these quick and loose, to pull some form out or to take what the other side offered up and read it quickly and say, yeah, this looks okay. I pretty much recognize this. Let's move on. Be careful. There are certain provisions beyond the important ones that you're focusing on, like how much are they going to pay me, and what's the delivery schedule and things like that. There are very important provisions in there that can really be a problem when it comes time to a sale. And I will tell you, there are things on this list that can definitely queer a deal or can really hit the purchase price in a significant way. So, for example, anti-assignment clauses. If you have contracts with important customers or vendors on favorable terms that have an anti-assignment provision, that is to say that contract cannot be assigned to another party without the consent of that counterparty, you may have a problem. Because when the time comes along for a sale and that contract is one of the assets of the company that you are going to assign over to the buyer, you need to be able to assign that contract over without going to the counterparty and getting their consent. And if you have a clause in that contract that says no assignment without consent, and that's an important contract on favorable terms, heaven help us all. Because at that point, you've given the counterparty leverage. And something, when that contract was negotiated, they might have been perfectly willing to give up on that anti-assignment provision. It may not have meant that much to them. But at the acquisition stage, when that's an important contract to you and an important contract to the buyer, they've got something on you. And they may not give that assignment clause, they may not give that consent without exacting something in return. A better price, an extension on terms which are unfavorable. If that affects your company economically, I can assure you it's not the buyer who's going to be paying the price for that. It's going to be you as a seller that pays the price for that. So that's an example of the sort of provision that seems very innocuous at the time when you're negotiating it, but can bite you later. And everything in this list is the same. Change in control provisions is sort of a similar example of the same thing, that if there is a change in control in your company, that contract becomes void, or you need their consent, or whatever it is. Rights of first refusal. This comes up sometimes in a contract with a strategic partner. They may want a right of first refusal when you're selling your company. How bad can it be? Well, it can be pretty bad, because if potential buyer A knows that a strategic, one of their competitors, big players in the marketplace, has a right of first refusal on your company, that's going to disincentivize them to try to negotiate a deal with you if they know that once they have a term sheet negotiated, you have to take it to their arch rival and offer that deal to them and give them a chance to undercut it. So you may end up chilling your exit opportunities if you give rights like that. Long-term leases and contracts with take-or-pay provisions, same sort of thing. You're putting a burden on the company that the ultimate buyer may not want to take on, and if it imposes a financial obligation that they don't want to take on, that will reduce your purchase price. Unusual limitations on liability, warranty commitment, same sort of thing. Exclusivity provisions, same thing. These are all sorts of things which put a burden on the company that will affect the purchase price. So, having said that, sometimes these sorts of provisions are the cost of getting an important deal done with an important customer or vendor or supplier, whatever it is. So you can't say don't give away provisions like these, but just be aware of what you're giving away and that it may come back at you. Any comments from the panel? All right. Personnel issues. Employees are always important in a transaction. In some deals, they are what the transaction is about. There have been some high-profile deals recently where the employees, the management team, is basically what was being purchased. And I've certainly had clients where that was what, the IP is nice and the product is nice, but what they really wanted was the team. But even outside of that situation, a team is almost always going to be important for a transition. So think about issues in connection with employees early. There are certain tools that you have that will be useful when it comes time to an acquisition. Generally, what's important is you want to be able to know that the key players will be there after the acquisition, that the tools are in place to keep them working for the company after the sale. Now, a critical tool that you have is vesting periods. So if your employees or management team has equity, you want to make sure that's equity that they vest into, and you want to think about the acceleration provisions. Consider having what we call double trigger acceleration on options and on restricted stock. Double trigger acceleration means that if there is a key employee, they have an equity interest, and there is an acquisition of your company, they don't automatically accelerate in all of that equity and be able to walk away. They will only accelerate if upon two things happening. First, the company is sold, and second, that they are terminated within usually a year without cause. So that's to say, as long as they continue to be employed by the company, they do not accelerate in their equity, which means they are incentivized to stay with the company, to stay for the transition, and which is what the buyer wants. If, on the other hand, all of your equity is single trigger, that is to say, upon the acquisition, it all accelerates and your employees can leave, you're again in a situation where you've given leverage to your employees, because you're going to need for some of them to stay on for the transition, and if all their equity has accelerated, you're going to need to give them more money or more rights, and again, that's not going to be paid for by the buyer, it's going to be paid for by you, by the seller. Other things to, and that'll come in the guise of a retention bonus or a severance package, and that's how that'll come out of your hide. Also think about non-disclosure agreements, invention assignment agreements, non-competition agreements if you can get them, work for hire agreements. If you have consultants, make sure all of the IP is assigned over to the company. All of these will become very important at the time of an acquisition. This is one of the things that the buyer will look for in the diligence process to make sure that all of the IP rights with your employees are tied down. Guys, any comments?
Yeah, just a comment with regard to the double trigger provision. It helps on the tax side as well, because we still have provisions that deal with golden parachute payments. I don't know if you're familiar with that, but if you have a golden parachute payment, it results in two things. Non-deductibility of the payment to the corporation, the company. Also, there's an excise tax imposed on the executive. So the double trigger provision effectively takes a change of control provision that's in an employment agreement and places it effectively outside of the golden parachute rules, at least in connection with that change of control itself. Now, if there is ultimately the severance, the severing of the individual, then it is going to apply then, because it will be viewed as a change of control payment.
All right. Okay, we've got 3 more slides. Mike, this one's
just to carry on with this, let's just go right to the tax issues with incentive plans. Generally, you're going to have stock option plans in place that are either non-qualified or incentive stock option plans. I don't know if you're all familiar with those. The differences really are the treatment. You could say that the stock incentive plans, that those are essentially qualified plans. And as long as you meet their requirements, the great thing about them is that there's capital gain treatment to the individuals who hold those stock incentive plans. If there's a change of control, however, and you don't meet all the requirements, then what happens is that they become disqualified dispositions, and there are deductions associated with that. There are also just regular non-qualified stock option plans, and that's things that most of us have. They can also trigger in a change of control, so you want to make sure that you know what those provide in the event that there is one. There's also a form, apart from incentive stock options and non-qualified stock options, you can have phantom stock or restricted stock. And these are incentive plans that that would be subject to what we have in here called the 83B elections. And just real quickly, if you have restricted stock, then that's like your phantom stock plan. You can make an 83B election once you're granted this kind of stock, and in that case, you're able to to treat everything after that as subject to capital gain in terms of the appreciation and value there. The 409A, you call it the Rule 409, but it's really 409A, Cap A. And that essentially is, that's horrendous if you don't comply with that. This was put into place after Enron, and what it's designed to do is to keep people from changing their plans so that they actually can receive compensation in advance of a change of control. So what'll happen is if you don't have 409A compliance, what'll happen is there could be a 20% additional income tax on the person who has this deferred compensation, and you end up getting taxed not at the time when you're paid, but at the time when everything vests. So if you end up if you have accelerated vesting in advance of a change of control, then you can end up having a tax sooner than you think. You also had independent contractors in here at the top of the slide, and that's a hot button issue with the service. In industries like this, high-tech industries, we tend to use freelancers, independent contractors. Basically, it's a worker classification issue. Are they treated as employees on a W-2, where they're receiving that subject to employment tax, or are they independent contractors where they're not subject to this tax? And the importance here is that there is a high level of awareness by the service on payroll taxes and ensuring that those are all being collected and withheld. So the ploy here is that if you treat somebody as an independent contractor, you can avoid that. So what they look at is how much control is being exercised over individuals. And if there's a great deal of control, then they'll assert that they're employees, and you'll end up with a big employment tax problem. Yeah.
All right. 2 more slides. We'll motor through them. If anyone has to leave, make sure you give me a business card if you want if you'd like a copy of the PowerPoint. Okay, protecting IP. We've touched on this a couple times. This again this can kill a deal for sure, and I've seen deals killed over IP. Unlike corporate housekeeping, I can't remember a deal ever getting killed over corporate housekeeping, but IP people care about. For those of you who are running tech companies, you know that may be the ultimate source of value. So what's important? The founders should have signed over the IP in the beginning. That should be sort of the first thing in the connection with the formation. When you get your equity, you give over whatever IP you've created up to that point. Obviously, there are certain things that may get carved out, but the IP that should be part of the company must be assigned over to the company, because that's one of the first things that the buyers will look at in the diligence process. They're going to want to see that the company owns the crown jewels. And if anyone has left, again, that could become a big problem. Employee documents, we touched on them before, NDAs, invention assignment, work for hire agreements. Your IP should be registered as necessary and should be policed appropriately. IP rights are like property rights. If you do not police and throw people off your property, they get adverse possession. If you do not tell people that they are infringing on your IP rights, they get, in a sense, adverse possession, or you lose the absolute rights in your IP. So do not neglect to enforce your IP rights. That is the province of an IP attorney. Open source software. I've seen deals get killed over this. When open source had been when they did an open source audit in the case of the sale, and the company's software was full of open source, and it can be a big problem. So you have to have policies and procedures in place, and you need to enforce them. Trade secrets. You may be familiar that an alternative to getting a patent is simply to keep your technology secret. And if you observe the appropriate formalities in terms of trade secret law, you can protect your technology by keeping it a trade secret. But you need to have procedures in place, and you need to follow them. And then finally, your agreements, again, customers, vendors, license agreements, whatever, they need to have proper attention to protecting your IP. All of this is very important, and it will be, the buyers will pay attention. Finally, I'll end with a favorite topic of corporate lawyers is securities laws. I'm not going to say too much about this, but I'm going to say don't ignore securities laws. Early stage companies tend to think, well, this doesn't really apply to us, we'll deal with it later. Well, it does apply to you. And if you get it wrong, the consequences can be severe. Enforcement actions, criminal and civil penalties, and rescission actions. That is to say, you have to give the investors their money back. Never a happy day if you get the securities laws wrong. But to go to our point, it can derail or slow an acquisition. Deals have gotten killed over securities laws. More likely what happens is that it slows it down, or it creates issues that need to be addressed. And again, time is not your friend. Anything that slows down the deal will ultimately hit the purchase price. Generally, what you need to know about securities laws is any issuance of securities, whether it's to a founder, a family member, a friend, an angel, a customer, needs to be registered, or there needs to be an exemption that you have identified and complied with. So that, that's, people seem to think, well, in the beginning I don't need to worry about it, I'll clean it up afterwards. I've had clients who've come and told me, well, we did this, we needed to raise some money, so he gave me $10,000. I took a stock certificate out of the book, I wrote it up, and I handed it to him. I assure you, in all likelihood, there was a violation of the securities laws at that point. These apply to debt securities as well. Convertible debt applies to LLCs as well as corporations, and it applies to when a finder, someone who says, well, I can help you find money as long as you give me 5% of the raise, or a portion of the securities, or whatever. Compliance with the securities laws is generally not difficult. A securities lawyer that knows what they're doing can usually find an exemption that you can comply with relatively easily, but you do need to comply with it. And if you don't, and if you try to do it later, sometimes you can clean those things up, sometimes you can't. You may find that you violate a securities law that you simply cannot be cleaned up afterwards. So these are the sorts of things that if you deal with them timely and properly, it's usually relatively easy to do. If you don't, it could be a real headache. Any comments on this? All right, that brings us to, we've run over a little bit, but we'll still take a couple of questions.
So, question probably for Mike.
Okay.
Any special considerations or advice for cash businesses, restaurants, and stuff like that?
Yeah, great question. When you're on the cash method, usually what's going to happen is in due diligence, from an accounting standpoint, they're going to, as you had said, normalize. What they're going to want to do is put you back on the accrual method, so that they can follow what GAAP is for you. Okay. On the tax side, you're permitted to use the cash method if you're an S corporation, okay, or in cases where you're providing services, you don't have inventory, or if you have a business, you could have a C corp that has $5 million or less on average of revenues. You can still be on the cash method. Cash method tends to defer, but what will happen in a deal, it'll defer income, taxable income for you. What will happen in a deal is generally there'll be a recapture of the deferral that you were enjoying while you are on that cash method, and the buyer will usually ask the seller to hold itself accountable and bear the tax cost of converting from the cash method to the accrual method. That's where you pick up that deferral. So it can be a cost to a seller when they're using the cash method in a deal. So they might enjoy the cash method deferral, while they're operating, but when it comes to selling the company, it could be a cost. That's the bottom line.
This is probably from Mike too. I understand the merits of double triggers, keeping key people at the companies to get that continuity, and I think I understand the tax points you raised as well. Is there another side of the coin though? Could the buyer save money and not have to pay a higher multiple on the company he's acquiring, and talk to the key employees and say, look, I'll pay you a lot of cash on the first 3 anniversaries? So at least they're not paying 5 times cash flow when they're buying the company?
Are you asking a question about the tax treatment of those items, or are you thinking about?
I'm not so focused on the tax treatments, but
the
you buy a
EBITDA.
company, you pay a multiple.
Right.
If you take the 5 key people and
Right.
say, there's no double trigger, but I'll pay you a good amount of cash for the first 3 years if you meet these performance metrics. You know, so that at least that way you're not paying a multiple of the company's cash.
Yeah, I think that's a good cash flow, solution for the future. Yes, I don't know if you all have a.
I think you're talking about an earnout, basically. I mean, that sounds like what so you're saying if you hit these targets, we'll pay you X over whatever the purchase price is we paid you at closing? Is that what you're talking about?
Well, it's kind of an earnout with the key people, but if you acquire a company, you have the key people, you pay a multiple on that. Or you're paying a higher acquisition price.
Right.
If you don't have the key people locked in with a double trigger, the buying company might be able to keep those people engaged by paying them cash at the anniversaries.
Right, yeah, it sounds like an employment agreement that you have set up with the key employees who might also have been owners. I don't know if they're also owners, but at least with the key employees. And what you're doing is you're establishing what their compensation is going to be and how it's going to work in the future. When we look at valuing a company, what we would be looking at is, all right, what if that is the norm? You would use the phrase, I liked it, the normalized level of what you would pay these employees over in the past for someone else to perform those same services. Well, that's the amount of compensation that we're going to look to when we are determining what earnings are. So I think that's what you're saying, that yes, that is an advantage to determining what that, if that's market, and if that's what, at an arm's length basis, what the buyer and the seller have agreed to, then that's going to be a good indicator for what the compensation expense should have looked like in the prior year for determining earnings and therefore your multiple. I think that's a great point.
Thank you.
Yeah. Let's take one more question, then we'll wrap it up.
You mentioned about recurring revenue being an important factor for services companies. Does the panel have any other thoughts on of a services company? What are the factors really matter? Like valuation or
Valuation?
you said recurring revenue is one of the key things for services companies. Is there anything else we should keep in mind?
Well, again, having bootstrapped, done as a profit center, and done as a publicly traded, I really boiled it down to what's basic. If you've got recurring revenue, it comes from client. You basically want to work backwards from that and say, okay, which customers are going to give me recurring revenue instead of one-at-a-time revenue? Then with the history, you can project what the recurring revenue is going to be to a buyer. And at least that gives you a basis to start. Did I answer your question? Okay, thank you.
All right, we've gone over a little bit. Thank you all, and thanks to the panel for a great presentation.